In this video, we're going to talk about 5 high-yield ETFs that have no NAV erosion and they pay you consistent income on a monthly basis. So let's not waste any time and jump right to it. This first ETF is Bali, the iShares Advantage Large Cap Income ETF. This fund seeks to provide consistent income with lower volatility than the broader US equity market. And it does this with a targeted strategy that's made up of the following. First is that it holds long positions in US large cap stocks, where it invests at least 80% of its assets into these large caps. It also may invest in shares of companies when they first go public through an IPO. Next, to generate that income, the fund sells call options on large cap indexes, such as the S&P 500 index. And last, it also buys futures contracts on indexes like the S&P 500. The reason for this is to try and lower the impact of the capped potential gains from using a covered call option strategy. For the fees, Bali has an expense ratio of 0.35%, costing you $35 for every $10,000 invested. Pretty reasonable here for a covered call fund. Let's get into the portfolio of Bali. This ETF contains a total of 180 holdings, with its top holdings in names like Microsoft, Nvidia, Apple, Amazon, Walmart, and others. For the sectors that primarily make up this fund, we have technology making up about a third here, then financials, communications, and consumer discretionary. Now for the dividends, Bali has a dividend yield of around 8.2%, which is paid out monthly. And if we take a look at the dividend payments over the last 12 months, you can see that it has fluctuated a bit over time, with the last few months showing the most stability. Bali has also had some pretty solid returns. Although it's only been around for 2 years, since its creation, it's had total returns, including dividends, of nearly 50%. So it's been doing well so far. Another fund that's a bit similar to this one is jepi, as it also benchmarks the S&P 500. And if we compare the returns of the two over the time that Bali's been around, you can see that Bali has performed quite well in comparison. And looking at price appreciation alone, so not including dividends, Bali has shown some nice appreciation as well. Bali is a unique fund that's geared towards those income investors who want some exposure to the S&P 500 that value high monthly income and the potential for higher returns from S&P 500 futures, lowering the growth cap from options. Next up, we have iwri, the NEOS Real Estate High Income ETF. This fund aims to generate high monthly income with the potential for capital appreciation, and it tracks the performance of REITs or real estate investment trusts. The benefits of iwri's strategy include combining exposure to the Dow Jones US Real Estate Capped Index with a data-driven call option strategy to give you that high monthly income. Second is that the fund seeks to offer upside potential in addition to its primary objective of high monthly income. And last, it can offer efficient exposure to a portfolio of US listed REITs with an enhanced layer of high monthly income potential, all packaged into one single ETF. Now, I want to give you a little bit more background on this Dow Jones US Real Estate Capped Index. This index tracks US REITs, which may include companies that directly or indirectly invest in real estate through development, management, or ownership, including property agencies. Companies are also capped within the index to ensure diversification, with no stock making up more than 10% of the index. The index is also rebalanced annually in September, with quarterly reviews in December, March, and June, along with the index generally having 60 to 70 or so holdings. Moving to the fees, this fund has an expense ratio of 0.68%, costing you $68 for every $10,000 invested. iwri contains around 72 holdings in total, with its top holdings in names like Prologis, which is one of the largest industrial REITs, Welltower, which is a healthcare-focused REIT, American Tower, which owns and develops broadcast and wireless communications infrastructure like cell towers and other digital communication assets. You have Realty Income, which is a grail when it comes to REITs, and even Public Storage, one of the largest self-storage facilities. Onto the dividends, iwri has a distribution rate of around 11%, which is paid out monthly. Now, when it comes to the dividend payments, since it was created in January 2025, you can see it has been relatively stable, with the range so far being between 46 cents and 51 cents. Since iwri was created this year, it doesn't have much history, but since January 2025, it's had total returns of nearly 8.3%, which is pretty good so far in 8 months. Now, don't expect returns to be up there with funds that track higher growth potential indexes like the Nasdaq 100, as this serves a different purpose. While iwri offers a quality portfolio with some decent diversification within the REITs that it holds, it doubles up on that income thanks to the yields from the REITs paired with the options income. Also, with the Fed starting to cut rates, this is a plus side for real estate and REITs for the most part, since borrowing becomes cheaper and they depend on debt to finance developments and property acquisitions. The next fund is gpix, the Goldman Sachs S&P 500 Core Premium Income ETF. Now, gpix seeks to provide regular income while also offering the potential for capital appreciation. And there's a couple reasons to consider investing in gpix. First is that it aims to provide consistent monthly income from option premiums and dividends. Second is that gpix offers core equity exposure with lower volatility through investing in the S&P 500, and it dynamically sells call options. By dynamic, it means that they're adjusting the percentage of the portfolio that they write call options on, and this can range between 25 to 75%. Last is for gpix's diversified sources of income with its lowered correlation to traditional income sources and their risk. Jumping to the fees, gpix is more so on the lower end here with an expense ratio of 0.29%, costing $29 for each $10,000 invested. For the portfolio breakdown, gpix contains a total of 508 holdings, with its top holdings in companies like Nvidia, Microsoft, Apple, Amazon, Broadcom, and others that you're likely familiar with. This fund allocates at least 80% of its assets to holdings that are within the S&P 500, so you're going to see it's very similar here and in the sectors for the most part. The sectors that this fund is mostly exposed to are technology, financials, consumer discretionary, and then communication, with the remaining 30% or so spread in other sectors. Let's talk about income, where gpix has a dividend yield of right around 8% and it pays monthly. Jumping into the last year of dividend payments, gpix has been pretty consistent, with its payments being between 32 cents to 36 cents. So it's been doing a great job with stability and consistency. As for the performance, gpix has only been around since October 2023, so just about 2 years, and since its inception, it's had total returns including dividends of around 55%. So really solid there. But get this, if we remove the dividend and just look at price appreciation, gpix has had price growth of about 33%. So a nice majority of those returns are coming from the price growth. As I said earlier, gpix's dynamic strategy allows them to adjust the percentage of the portfolio that they write options on, and if they lower this percentage amount, then it basically reduces the upside cap. So in booming bull markets like the one we've been in, let gpix benefit from more upside appreciation by writing options on a lower percentage of the portfolio. gpix has proven to be a solid contender as a S&P 500 based income fund in the short period that it's been around, with an expense ratio on the low side, a solid dividend yield, stable income, and some pretty impressive growth. Next, we have igld, the First Trust Vest Gold Strategy Target Income ETF. The objective of this fund is to track the performance of the SPDR Gold Trust while also providing a consistent income stream for investors. This fund works much more differently than the others on this list, and I'll be explaining how shortly. But first, its strategy to generate income comes from two parts. First is that igld invests in short-term, 1-month treasury bills. And second is that the fund uses flexible exchange options, which are also known as flex options. And flex options are different from standard options as they allow investors to customize contract terms like strike or exercise prices, styles, and expiration dates. Now, when it comes to the option strategy of igld, it seeks to gain synthetic exposure to GLD by using a combination of flex options, buying call options, and selling put options. How this works is that the fund will buy call options and sell put options in order to be exposed to both the upside and downside price movements. So this is where synthetic exposure is. And in order to protect the strategy and improve income potential, the fund will use a partial covered call strategy by selling at-the-money call options on GLD to cover short positions. This acts as a hedge against market declines, and by selling call options, the fund aims to generate additional income through option premiums by turning some of GLD's growth potential into income. As for the cost, igld comes in a bit higher with an expense ratio of 0.85%, costing $85 for every $10,000 invested. Now, when it comes to the holdings for igld, it's really just going to be US Treasury bills, and if you see anything additional, that would be those flex options listed. Instead of directly purchasing shares of GLD, the Spider Gold Shares ETF, igld does it through an affiliate or subsidiary in the Cayman Islands that purchases flex options. Getting to the dividends, igld has a dividend yield that's up there in the double digits of just around 16%, which it pays out monthly. Now, if we take a look at the past year of payments, you can see for the most part, it's been very stable and consistent. But there was one huge payment in December 2024 of around $2.40 a share that stands out. This is because igld can make a large payout like this when the fund is experiencing some nice growth. Getting to the performance, igld has only been around for a few years, so it doesn't have a ton of history, but it's had total returns, including dividends, of over 80% in the last 3 years. And in the past year, returns of around 32%, thanks to gold really being on a strong run. For investors looking for monthly income, a nice yield, along with exposure to gold and the potential for capital appreciation, then igld might be one to look into. This next ETF is iwmi, the NEOS Russell 2000 High Income ETF. This fund seeks to generate high monthly income in a tax-efficient manner with the potential for capital appreciation. There are 3 main benefits of iwmi's strategy. First is that it aims to provide monthly income from investing in a portfolio of stocks that make up the Russell 2000 index and using a data-driven call option strategy. It also takes advantage of tax loss harvesting opportunities along with using Russell 2000 index options, which are favorably taxed. And index options are classified as Section 1256 contracts from the IRS, which allows them to receive 60% long-term and 40% short-term capital gains tax. Third, it uses a call option strategy that may include both sold and purchased Russell 2000 index options. For the fees, iwmi has an expense ratio of 0.68%, costing you $68 for every $10,000 invested. Moving to the portfolio of iwmi, you'll see that it holds the Vanguard Russell 2000 ETF VTWO, so we'll be talking about that here. This Russell 2000 ETF contains a total of 1,999 holdings, with its top holdings in names like Credo Technology, Kratos Defense, Bloom Energy, IonQ, and more. While there's quite a lot of holdings, you can see that there aren't any stocks that hold a high percentage amount, as well as the top 10 holdings only make up a few percentage of the entire portfolio. For the sectors, VWTO is primarily exposed to industrials, financials, and healthcare, making up the top 3 here. Shifting over to the income for iwmi, this fund has a really nice dividend yield of over 14%, which is paid out monthly. And the past 12 months of income have been good as well. You can see that the payments have varied some, but it's relatively stable, with the income mostly in the range of 55 cents to 61 cents a share. So it's nice to see the consistency that it's managed to provide. As for the performance, iwmi is still fairly new as it was created in June 2024, so a bit over a year now, but since then it's had total returns including dividends of around 18%, so not bad at all. Now, something to keep in mind is that unlike the other funds on this list, this one does currently have a small amount of NAV erosion, roughly over 1% since it's been created, but I think one thing to note is that the outlook for small caps is starting to look much better given that the Fed is on the path of cutting rates, which is favorable to small cap companies. The increased interest rates over these past few years have weighed down on small caps and their valuations have declined by quite a bit, and the tariff concerns of earlier this year just added some salt to the wound. Even if we manage to stay on a steady path of having some slow economic growth and no sudden shocks or downturns in the market, then there could be some nice potential opportunities with small caps. So for those income investors that are not only looking for a fund that provides a double-digit yield, but some added diversity by having small cap exposure, this could be a fund to look more into. And if you want to see some more options of some of the best monthly income ETFs that don't have any NAV erosion, then watch this video here, or watch this video here to see 2 new ETFs that could beat the popular monthly dividend ETF jepq. If you made it this far, I really appreciate you watching. Also, don't forget to tap that like button and subscribe. Keep on investing, and I'll be seeing you in the next one.